Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 21st of August 2020, and yesterday we published a video entitled US dollar rises after FOMC minutes, gold and silver decline. And on Wednesday, gold and silver dip ahead of FOMC minutes, where we reported that although gold had earlier peaked at $2,015 and silver at $28.48, they had fallen back to $1,970 and $27.40 respectively prior to the FOMC announcement, and then falling again after the announcement at the time that we produced yesterday's podcast, where gold then stood at $1,933 and silver at $26.93. Now currently at 1600 hours, yes, I'm just checking, 1600 hours GMT plus 1, gold stands at $1,943, some $10 higher than yesterday, and silver at $26.75, a little down on yesterday. But they were even lower a couple of hours ago, which frankly is not surprising, bearing in mind that the dollar index has strengthened by 0.6 to the current level of 93.3. So the falls that were occurring, but they're starting to recover now, were consistent with that dollar rise on a percentage basis, so far at least. Now we thought today we would share the views of BullionVault, an organization we've recommended in the past, and of course an organization that is likely, by the nature of their trade, to be more bullish than bearish gold and silver, but whom we generally regard as being moderately objective in their analysis, bordering on the mildly bullish side, rather than the alternative, which are the pumpers, who are calling for $10,000 gold tomorrow. Now these two articles we shall read, the one dated yesterday, asking the genuine question, and it's the longer article, if gold has reached its top, short term at least, and the other being a little more bullish than the first. So let's take a look at these two articles. Bloomberg article dated Thursday 20th of August, 1317 GMT plus 1. Headline, is this the top for gold? Metal's real value at 50-year high. 20 years ago, the dot-com bubble peaked and crashed. Right alongside, gold prices finally stirred after 2 decades of falling, starting what has gone on to prove a long, if volatile, uptrend, making gold the very best performing asset class of the 21st century to date. Back at millennium's turn, that seesaw made sense. Tech stocks marked the apogee of human ingenuity and progress. Their ensuing collapse marked the return of history, punching a hole through the Western world's hubris and inviting a useless lump of metal to become the most useful asset an investor could choose. Despite it famously doing so little, it cannot even corrode. Fast forward 20 years, however, and here in late summer 2020, with SARS-CoV-2 still laying waste to lives, loved ones and livelihoods everywhere, while outside its source city of Wuhan, both tech stocks and gold prices have shot to fresh all-time highs. How so? In a world lockdown, in a word, lockdown. Stuck at home with nothing better to do, the Western world's most cash-rich households have seen their bank accounts swell thanks mostly to the collapse in their daily outgoings. Handed this bump in discretionary cash, everyone has tried to escape online, accelerating yet another trend already long underway, together with massive deficit spending by government and negative real returns to cash in the bank. Hence the surge in online shopping, led of course by dot-com bubble poster boy Amazon, with that relentless knocking on your front door making Jeff Bezos the richest man in the world. Searching, downloading and streaming has also leapt, driving expectations of bumper profits for Alphabet and Netflix, as has online stock trading in those very same shares. Hence the need to try ensuring those equities with a little physical bullion. Locked up under house arrest, institutional and retail investors alike have driven gold to new all-time record prices. Priced in dollars and cents, or pounds and pence, or euros and cents as well, gold has really gone higher. Only ever on a handful of days, in fact, all of them within this month of August. But faster still has been that surge in tech stocks. From March's COVID crash lows, software hiding as hardware brand Apple has doubled in price and is now worth $2 trillion according to the stock market. That's a lot of money. More than GDP of a host of countries. Gasps pretty much every financial hack the world over, including Italy, Brazil, Canada and Russia, South Korea, Spain, Australia, Mexico, Indonesia and Netherlands, Saudi Arabia, Turkey, Switzerland, Taiwan, UAE and Norway, among many others. Okay, but that's only in cash terms, and there's always plenty more where that came from. So what about tech stocks in terms of gold? What is human ingenuity, now priced higher than ever in dollars and cents, worth in the deathless metal? As you can see, the dot-com tops disaster for gold remains a long way from here. So too does gold's big comeback a decade later. To match Y2K's low, the incorruptible metal, that famous bet against humanity's apparently relentless progress, would need to lose 2/3 of its value in terms of the US-listed tech shares it can buy. But to match its own 2011 peak in terms of the Nasdaq, gold prices would need to quadruple. No conclusions here then. So let's put Apple to one side and Amazon and Microsoft, both now worth some $1.7 trillion according to stock market punters. What is gold really worth today? What is the metal's true value rather than simply its price? I have a question, asks a very clever BullionVault user. They're all top drawer smart because they've entered the 21st century's biggest bull market using the cheapest, safest, easiest route to outright ownership with instant liquidity. Little plug there for BullionVault. And his question is a humdinger. Is there a relative gold buying power commodities basket index that can be used as reference comparator to give an indication of the over-undervaluation of gold over time? I am aware of the chief drivers of gold and the various well-known yardsticks such as silver, albeit subjective, wages, property, loaves of bread and bespoke suits, but a more modern combined benchmark would be extremely useful. An excellent question, because while all those loaves of bread, suits of clothes, bricks of clay and other commodities offer some kind of yardstick, the oft-repeated claim that gold always returns to its long-run historical value just feels that bit too neat. Very long-term historical data are unreliable by their very nature. And besides, the nature, or rather utility and therefore human value of such yardsticks does change over time, unlike incorruptible gold. What is the true equivalent of a Roman toga and a pair of sandals today? 20 years ago it was a rented wedding tux from Moss Bros, but now you might ask around Savareau for a COVID discount. And who really wanted to swap 1 ounce of gold for 350 ready sliced loaves in 1998, back when a study for the World Gold Council's matched gold's then prevailing value to the time of Nebuchadnezzar 2,500 years before? Never mind 350 handcrafted artisan sourdough baguettes today. To update with more reliable metrics, how about raw material costs for manufacturers over the last century? This tracks the US Producer Price Index, raw, red, left, against that same index divided by the US dollar gold price, yellow, right. As you can see, input in dollar terms are currently at levels first reached at the top of the commodity supercycle back in 2008. But in gold, they're as cheap as any time since 1970. Alternatively, and a little closer to home for our British customers, here's the pound in your pocket, again since 1970 in terms of the UK Consumer Price Index. Accepting that again such indices are highly arguable, even over just half a century of technological and social change, this shows, green line, left axis, that where a pound used to buy 12.5 units of stuff in 1970, it now buys 0.9 units. That's inflation for you. But the purchasing power of gold in contrast, yellow right, has never been higher. Are either of these measures perfect? Might we be missing our client's very apposite question? No and yes, respectively. But using data from the US, and UK's standing armies of statisticians and econometricians, we do think they suggest we are at significant levels in terms of gold revalue right now. By itself, that might sound like a sell signal, but sell for what? Cash is trash, as central bankers keep promising. Yes, that's because they're so very worried about the COVID catastrophe becoming a deflationary depression. But will you dare to fight the Fed by betting they won't unleash more QE, or target zero bond yields, or follow Japan, the Swiss, and the 19-nation Eurozone in going negative on nominal overnight rates, or agreeing to all-out debt monetization, aka MMT, modern monetary theory, from the Treasury itself? Real estate, in the meantime, is falling at the top, and stocks have never been so highly priced in dollars, nor so rich, on this pundit's view at least, in terms of the earnings collapse ahead. Versus the COVID-fueled Nasdaq, remember, gold is currently worth only a quarter of its 2011 peak. Sellers may also face a risk that, while gold could be reaching a peak in real terms, it will now hold that real terms plateau even as the cost of living rises. Should central bankers win and inflation swaps the threat of deflation, can you really imagine the true value of gold falling faster than cash as inflation accelerates? Interesting article by Adrian Ash, Director of Research at BullionVault. BullionVault article dated 21st of August 2020. Headline: Gold price correction. Article written at 0901 GMT +1. I believe gold and silver are just getting started, writes Frank Holmes at US Global Investors. The price of gold had its first down week since early June last week, ending a spectacular 9-week rally, the likes of which we haven't seen since 2006. The yellow metal briefly fell below $1,900 an ounce as stocks neared their all-time closing high, and the 10-year Treasury yield jumped on record supply of new debt from Washington. Wednesday's $38 billion auction of 10-year government bonds was the largest in US history. Before the resulting drop in gold prices, the metal was looking overbought at more than 2 standard deviations, so a short-term correction was to be expected. It's important to keep in mind, though, that the metal's long-term drivers remain intact. We have unprecedented monetary and fiscal stimulus, with more potentially on the way. There's still trillions of dollars worth of global government debt trading with a negative yield. Despite the correction, gold continues to trade in a golden cross. That's when the average price for the past 50 days trading is above the average price for the past 200 days trading days, and it's typically seen as a bullish signal. The current golden cross has been in place for more than 18 months now. I believe the one factor that's missing from this bull run is inflation. Since the financial crisis, we really haven't seen a significant change in consumer prices, if we're using the Bureau of Labor Statistics gauge. We may be on the verge of a new inflationary period, however, based on the latest report by the BLS. On a month-over-month basis, core inflation, that's inflation on all items excluding volatile food and energy prices, rose 0.6% in July. That may not sound like much, but it's the biggest such increase since 1991. According to the Bureau, the monthly change was led by a sharp rise in auto insurance prices. Other increases were seen in shelter, communication, Medicare, and used cars and trucks. Historically, inflation has been constructive for the gold price. As the purchasing power of the dollar falls, savers and investors may seek other, more reliable stores of value, including the yellow metal. And that was written by Frank Holmes, Chief Executive Officer and Chief Investment Officer of US Global Investors, Inc. Okay, now we've expressed in the past that the recent pullbacks should really be deemed as positive, and in fact are necessary, as to have prices just continually rise without a pause for breath and minor corrections, one will find that it will not rise to the levels that they could rise if those pullbacks and short-term corrections take place. And we suspect that both gold and silver will re-rise in the months to come. Perhaps not quite as high as the pumpers express that they will, but certainly will regain the previous highs. What do you think? Do share your thoughts, and tomorrow we'll be providing our weekly update where we shall be looking at all of the economic data, or most of the economic data published this past week, and then looking forward to what's being published next week and how that may affect gold and silver prices moving forward. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.